Let's talk numbers. Ajay Kaul, Chief Executive Officer of Jubilant Food joins us to talk about the quarterly performance. Ajay, there is good news and bad news. Good news is, as you know, business is growing and business is growing on a large base at a robust pace. But margins, 100 bips down.
Okay, let's focus on the good news more than the bad news, if that is how you want to classify it. But I must tell you that even behind the so-called bad news, there are some definite reasons to it. And we believe these are reasons which can be, turned upside down, and hopefully with a bit more help from the economy, GDP growth going back to, let's say, 7-8 kind of percents, we will spring back to what we have seen in the past, 30% same store growth kind of numbers. But let me focus on the good news first. You know the backdrop, how the sentiment coming from all corners of the country is not very positive. And even in the last 3 or 4 quarters, I have been very consistently saying that while it is not worrisome for our business, which is the Jubilant Foodworks business, because our numbers still look, at a 20% same-store growth, 42% system-level growth, these are good numbers anywhere in the country, anywhere in the world, I would say. But early warning signals given by the consumers is visible, is continuing. Against that backdrop, these numbers look even better. Now, what has happened in the meantime is we've also realized that while all this may be happening, the opportunity which the country as a whole is throwing for us is humongous. And as a result, you may be aware that we have upped our guidance on number of new stores that we will open this year. We had earlier said 90, last quarter we changed it to 100, and we are confident that we will be able to open 110, at least 110 new stores by the time we hit March 2013. Now, in order for us to beef up our whole infrastructure, basically people, whether it's people who are looking for stores, people who are going to fill up, positions inside the stores, and so on and so forth, I think all those costs, looking into the medium term, are coming into the P&L, which are making it a look, probably from a margin perspective, not too rosy. But there are 2 additional factors we need to keep in mind. One is Dunkin' Donuts, which was not in our business last year, is at a stage where the stores are very few. It's predominantly right now giving us, some losses because the volumes are still not large, although we are very optimistic, and we'll talk about it in greater detail at some stage during this conversation today. There's an impact of around 0.8, 80 basis points, impact on our EBITDA. Additionally, something which we didn't know at the beginning of the year was this service tax, 10% becoming 12%. That has given additional 50 basis points impact. If you club these two together, it's 1.3% impact. But when you compare it, let's say last year, same quarter, and this year, our depletion is only around 8.9%. So we have still been able to improve our margins, despite a 1.3, 1.4% impact because of just these 2 reasons. So you got to isolate or delayer the whole thing, and then look at it. So even behind the bad news, the seemingly bad news, there is not so bad news. It is good news, and we believe as we move forward, at some stage, Dunkin' will start, turning around because it will become bigger. And also some of these service tax impacts will, on a year-to-year comparison, will start getting obviated. So that is, in a nutshell, the good, and I would say still seemingly good news and not bad news.
Okay, fair point, Ajay. But, like you were reiterating, you have increased your new stores targets to now 110, increasing it by 10 stores. Does that also equate to margins continuing to be under pressure as the operating expenses like materials consumed, employee costs, rentals as well, would see an uptick?
See, you have to beef up your basic infrastructure of people, because you are building business for the future. And if you look around in our immediate space, retail, and if you go even inner, which is the food retail space, there is nobody close even to half that number. 110 stores for the year, probably nobody else would be even opening 50 stores, I would reckon. So it's by far, a very huge number. But because you have to beef up people in all spheres of our business development projects, people who go and fill up the store. So you have, let me add one more point here. In the month of May, while we increased salaries for everybody, we gave a special increase this year for our store managers and people who are below the store managers, who are our future store managers. We know that, the pool of resources available to us is not anywhere else. because we are the single largest player. We are the largest MNC QSR brand. We are the fastest growing. So we have to create, you know, bench strengths. We have to create ways by which we create a battery of managers who can fill up the future. So you have to beef up, and there is an element of cost coming into it, but I would say it's a short-term cost, feeding or beefing up, you know, medium-term benefits where 110 stores at least will come in this year, and we are hopeful that that's a number which we can repeat year after year. So that is, you know, you got to somewhere keep the short term as well as the medium term in mind when you're having this discussion.